All right, welcome to our discussion on equity investment. In this section, I'm going to start off discussing the basics of US common shares or common equity, and then in a follow-on video, we'll take a look at some of the big events in the life of a stock. So we'll talk about dividends, buybacks, also known as repurchases, spin-offs, some other events, and then in our final video on this section, I'll talk about how we collect this data. So let's get into it. What am I going to do in this intro video? Well, I'll talk about the pros and cons of common stock or common equity. I'll show you the annual returns historically on common shares. We'll walk through the basic stock types and some definitions that you should absolutely know. And finally, we'll compare the intrinsic and market value of stock. So there are a lot of definitions here that you should absolutely remember, certainly for this class and certainly outside of this class. I mean, there's a reason why we do this. Okay, so there's many benefits to owning common stock. First, as you're aware, stocks historically outperform bonds by a significant amount. Just to illustrate this, I pulled some data from 1926 through 2023 on the S&P 500 index, and what you can see is, yes, absolutely, historically, the S&P 500 has a positive and pretty large return. I mean, I think our average over the last 100 years, or almost 100 years, has been about 9%. But as you can see, it's really only in very few years where we have these very, very large sell-offs. So like 2008, 2020, obviously 29. I mean, we had this big run during the Great Depression. So yeah, that's that. Next, stock represents residual ownership in a firm. As I mentioned a few lectures ago, this means that in the case of a Chapter 7 bankruptcy or liquidation, where assets are sold off, once the bondholders, employees, and the government are paid what they're owed, the shareholders get what's left. Usually that's pennies on the dollar if there's anything left. Next, most stocks offer voting rights. This point is very important. Besides the total return that shareholders receive, voting rights are arguably the second biggest benefit. As a shareholder, you get to vote in the annual shareholder meeting. Typically, that's going to happen during the spring. Now, in class, we're going to take a look at some proxy statements, also called Def 14As. So you're actually going to see what items actually come up for a vote. Next, in the US, stocks are pretty easy to buy and sell via a broker. US stocks on the NYSE and the NASDAQ are highly liquid, and nowadays your brokerage fee on small stock purchases and sales is zero, or at least your explicit fee is. And finally, in the US, price and market information are easy to find in the news and financial media. There's literally thousands of sources you can use to find data concerning a stock. Therefore, any diligent investor is going to be able to identify an intrinsic value for a stock fairly easily if we have a lot of information. Now, the big drawback to stock ownership is the volatility of stock returns. Even our best return prediction models for a single stock are abysmal over short time periods. Remember, this is part of the reason why we want to diversify our portfolio and hold a diverse array of securities, like we talked about a couple lectures ago. Diversification will decrease the volatility of our overall portfolio. The other big drawback of stocks is that they distribute less current income compared to other investment alternatives. If you're a pensioner or retiree and you live off the income of your portfolio, it would be foolish of you to invest in most US stocks, since most US stocks do not pay dividends. It's only really the blue chip companies in most cases that actually pay dividends. All right, let's try a CFA question. So common shares do not entitle investors, A, to a share of the company's operating performance, B, to participate in decision-making in the form of proxy voting, or C, to fixed dividend payments. Well, the correct answer here is going to be C. Now, I literally just copied these questions word for word, so I don't really agree with the grammar on this one, but yeah, I'm going to assume that means fixed dividend payments. So quite frankly, you as an investor in shares in U.S. companies, you're not entitled to fixed dividend payments. Companies determine whether they want to pay dividends, and they determine the amount they pay. This is for common stock. So if Apple decides they don't want to pay a dividend this quarter, well, you don't get a dividend this quarter. All right, one more CFA question. Which of the following decisions is least likely to be the one which common stockholders can vote on? A, auditor selection, B, dividend payments, or C, merger decisions? Well, since we're talking about dividends, I think you can probably guess correct answer here is B. That vote or that decision is going to be made by the board and management, and you as a shareholder, you just get the benefit of dividends. The items that do often come up for a vote are going to be whether or not your company uses a certain auditor, like a Big Four auditor, or if the company is possibly going to be acquired, you may get to vote on whether your company that you invested in gets acquired. Okay, now we're at the definition part of this video. So I apologize, I hate definition stuff, but it is important. You should know pretty much every single one of these definitions. I mean, this is kind of like the intro stuff. So some of these we've already used in class. Certainly on this slide, you've already heard these terms, but I wanted to formalize these based on how they're formalized or used in by professionals. So when we have large cap stocks, that's going to be any stock with a market cap above 10 billion. And, if we're talking about total U.S. market cap, these are going to represent a huge portion of the total U.S. market cap. I have 75% here, but over time, that number has been creeping up, 75, 80, 85%. Next, we have mid-cap stocks, and this is any stock with a market cap between about 2 and 10 billion. These definitions or these breakdowns do change over time. Historically, this mid-cap definition was a lot lower in terms of market cap. But there's a couple things you should know about mid-cap stocks. They do offer better growth opportunities than the large-cap stocks, but they're also much more volatile. They are, however, less volatile than small-cap stocks. And that leads me to, obviously, small-cap stocks. And small-cap stocks, depending on who you ask, these are going to be stocks with a market cap of about less than $2 billion. Some people say there's a definition out there called micro-cap stocks, which is anything less than about 100 million or 500 million. But small-cap stocks are kind of like the third big grouping of stocks based on size. These are very illiquid. They're not widely traded, and they're very, very highly volatile. Next, we have speculative stocks. So speculative stocks are stocks that offer the potential for substantial price appreciation, but these stocks historically have a pretty poor track record. Let me give you an example. In 2019, Zoom Communications, the company that produces Zoom, would have been considered a speculative stock. Drug companies that currently have a product in development that could lead to billions in shares are sometimes also considered speculative stocks. An example of this would be Moderna Therapeutics, which in mid-2020 was developing a potential vaccine for COVID-19. Any news of promising developments for these stocks can lead to a one-day return of easily 5 to 10%. I mean, these stocks, we see very large pops or jumps, and we can see very negative jumps. Now, another definition you should know are tech stocks. And I mean, this one's pretty self-explanatory. These are stocks of companies in the tech sector. Most of these stocks in the US are probably going to be listed on the NASDAQ if they're big enough. And these firms that are in this tech space, they're going to produce computers, semiconductors, data storage devices, software, internet services, et cetera, et cetera. And we all know the big players in this sector. We have the FANG stocks, the Magnificent Seven, companies like Facebook, Apple, Amazon, Netflix, Alphabet. Historically, these stocks offer pretty high returns, but typically tech stocks are going to have very, very high volatility. Next, we have to discuss the difference between cyclical and defensive stocks. And cyclical stocks are stocks that perform well during bull markets. Their earnings are positively correlated with the health of the overall economy, and during expansionary periods of the business cycle, these firms are going to do very, very well. During contractionary periods or recessionary periods, these are the stocks that are most likely to have very poor returns or even default on their debt. These stocks include companies like airlines or home builders. Cyclical stocks also include the producers of durable equipment like Caterpillar, since people don't make as many large equipment purchases during contractionary periods of the business cycle. Now, cyclical stocks historically have high betas. That's one of their defining features. So companies like Ford and GM will have betas of about 1.5, 1.6. A lot of the airlines will have similar betas. High betas are one of the defining features of cyclical stocks. Now, alternatively, we have defensive stocks. And defensive stocks are stocks that tend to hold their value and even do better when the economy starts to falter. These are stocks that typically have low betas, and they sell products that everyone needs during a recession. So these stocks would include grocery stores like Walmart and Kroger, producers of non-durable goods like WD-40 would also fall into this grouping, and then producers of medicines that people need every day to survive, like insulin, would also be included in defensive stocks. Okay, next we have blue chip stocks. And blue chip stocks are just the stocks of large, well-defined, or well-established firms, and very often these stocks are going to pay dividends. These are typically the leaders in their industry. I know I used the term blue chip stocks when I showed you the Dow Jones Industrial Average. These stocks historically are less risky than most stocks. If you are looking for a safe bet, blue chip stocks are really what you're looking for. These are stocks of companies like Coca-Cola, McDonald's, the companies that have very, very low default risk and have very, very consistent cash flows. We also have a term out there called income stocks, or income generating or income producing stocks. And these are stocks with a long history of regularly paying higher than average dividends. These are the stocks that people close to retirement or in retirement are going to be targeting. So these are going to be stocks of companies like Apple, which pays a massive dividend, Altria Group, Duke Energy, Brown-Forman. These are companies that have historically paid very, very large dividends, and the dividend might represent the majority of the total return on those stocks. Now, before I describe the next two types of stocks to you, I need to refresh your memory on book and market value. Book value is the price per share of a firm's shareholder equity on its balance sheet. It's just assets minus liabilities divided by the number of shares outstanding, if we're talking about book price per share. The book value of equity is often seen as a backward-looking estimate of value because it reflects the past performance of a firm. For a forward-looking measure of firm value, we need to look at market value. And market value is the current price per share of a firm's stock listed on an exchange or, the last time it was traded. This price, the market price, represents what investors are willing to pay to purchase the stock today based on their expectations of future cash flows discounted to the present. Now, historically, the market price per share has been greater than the book price per share or book value per share of a stock, with very few exceptions. In fact, the average market to book ratio has historically been between about 1.5 and 2.5. Now, as professionals, we focus on the market price per share far more than we do the book price per share. And the reason for this is because we're often more focused on the actual amount a stock is worth or should be worth, rather than I would call it the accounting fiction that is the book value. And this is where obviously finance differs from accounting. Accounting, they focus a lot more on book value. Finance, we focus more on market value. Accounting focuses on balancing the balance sheet. In finance, we tend to focus on what something is worth and should be worth. All right, so I mentioned book value and market value to get to something called the book to market ratio, but we do have two other definitions before we get to that. They are the intrinsic value and the target price. Now, the intrinsic value is one of the most important concepts that we have in investments. This is probably our most important definition of this video. The intrinsic value is the value that this asset should be worth. It's the discounted value of an asset's future cash flows. It's what you should be willing to pay for this asset, be it a stock, be it a bond, whatever. Now, some people will call this the fair value. I think several textbooks will call this the fair value. This thing is the thing that we calculate in valuation work. Now, there is a hard and fast rule. The most important rule in investments is this thing right here. If your market value is less than your intrinsic value, buy that asset because that asset is undervalued. And vice versa, if your intrinsic value is less than the market value, sell that asset or short that asset. So that's the intrinsic value. We compare it to the market value and determine whether something is undervalued or overvalued. Now, going along with the intrinsic value, we have the target price. And the target price is something that you see all the time in brokerage reports, and it's really just the price or the valuation that an analyst has assigned to an asset 1 year from today. Basically, what should this asset, usually a stock, be worth 1 year from today? And the way they calculate that is by taking the intrinsic value that they've estimated, multiplying that by 1 plus the expected return on that asset during the year, and they get their target price. And typically, they'll use something like the CAPM to estimate the expected return over the next year. Okay, so one final CFA question for you. Which of the following statements is most likely to be correct? A, management can directly influence both the book value and the market value of the company. B, decrease in book value will automatically cause a company's market value to decrease. Or C, a change in investors' expectations can impact a company's market value. I think there's potentially two correct answers here, but the most correct answer here is going to be C. If investors believe that a firm has no good growth prospects or is unlikely to be profitable in the future, that's going to dramatically impact the market value because investors will revise their intrinsic value of the asset downward and they'll start to sell off shares, and that'll lead to a decrease in the market value. So correct answer here is certainly C, although you could probably make a case that A is correct if a manager has a lot of influence, because managers can make public statements and they can sell off assets. They can do all kinds of things to influence this, but the most direct answer, the most correct answer is going to be C. Okay, so the final definitions I have here are growth and value stocks. And these are the, stocks or the definitions that I had to mention, market to book, market value and book value before I could actually talk about them. So let's talk about these. Growth stocks, these are stocks of companies that have very high market value of equity divided by book value of equity. So they have a high market to book ratio. And typically, when you have a high market to book ratio, what this indicates is that the growth prospects of the firm are much, much higher than the book value of the firm. There's all kinds of examples of this. Typically, growth stocks are going to be stocks that are growing rapidly, like tech stocks or pharmaceutical stocks that have their entire valuation based on drugs that are going through drug trials. On the flip side here, we have value stocks. And value stocks, again, these are the opposite of growth stocks. They're stocks with low market-to-book ratios. Now, we previously defined this in terms of book-to-market ratio. You can flip this and, basically value stocks would be stocks defined by high book-to-market ratio. But here we're defining it as a low market-to-book ratio because outside of factor analysis, this is typically how we think about it. Basically, value stocks are stocks of companies that have been established, they're usually profitable, and they've been around for a long time. They have really not a lot of growth prospects. Best examples I can give you would be the stocks of railroad companies that have already built out track, or established industrial companies that have been around for 50 years and still make a reliable set of products. Okay, so let's summarize. We can categorize stocks using many definitions. This was the definition video. We have some definitions that are very important. You should know the definition between cyclical versus defensive stocks. Cyclical stocks outperform defensive stocks during bull markets. Defensive stocks outperform during bear markets or downturns. As investors, we care more about the market value than the book value of stock. Very important concept. Accountants care way more about the book value of stock. And I also talked about the intrinsic value of stock, or the intrinsic asset, or the intrinsic value. And this is probably the most important definition I talked about. It represents the value that an asset should be worth. We typically, if we have complete information, what we'll do is we'll forecast cash flows and discount them to the present. And then finally, to determine whether or not you should buy an asset, you compare your market value of that asset to the intrinsic value you calculated. And if your intrinsic value is greater, buy it. If intrinsic value is less than market value, sell it or short it. So with that, I'm going to conclude. And if you have any questions, please feel free to reach out. Thank you.